On January 1st, 2026, the rules of American banking will quietly shift. No alarms, no breaking news. Yet this single policy update will change how banks hold capital, how they move money, and how they react the moment financial stress hits. Regulators call it the Basel III endgame. Bank CEOs call it a mistake. But for ordinary people, the real story is much simpler. This rule doesn't target your balance, it targets the speed of the system that protects it. Because when banks are required to lock away more capital, they become far more cautious with liquidity. Transfers slow, reviews increase. Large withdrawals face extra steps. Retirement custodians tighten procedures. Nothing dramatic, nothing illegal. Just friction exactly when you want clarity. In this video, we're going to break down what actually changes on January 1st, what does not change, and why so many misunderstand the difference between money you own and money you can access on demand. If you understand that difference, this rule becomes far less frightening and far more important. On the rule change. On July 27, 2023, U.S. regulators quietly announced a new plan for the banking system. Most people didn't notice it. It wasn't dramatic, it wasn't loud, and it didn't sound like breaking news. But behind that quiet headline was a rule change that will reshape how American banks handle money from now until 2026. The name of that rule is Basel III Endgame. Sounds complicated, but the idea is simple. Regulators want big banks to hold more of their own money as a safety cushion. Think of it like telling a family to keep a bigger emergency fund before taking on any new spending. It doesn't mean the family is in trouble, it just means the rules got tighter. For the banks, that cushion is called capital. When the government raises that requirement, it forces banks to keep more money inside the vault and take fewer risks outside. That's great for stability, but it reduces their freedom to move fast. Less lending, more reviews, more hesitation, less flexibility. And that is exactly why the banks pushed back. Jamie Dimon, the CEO of J.P. Morgan Chase, the largest bank in America, said it bluntly. The devil is in the details. A lot of these rules are hurting lower-paid individuals. He wasn't warning about a collapse. He was warning about tightness, a slow, uncomfortable squeeze that affects everyday people who just need their money to move when they ask for it. Because here's the part that regulators don't say out loud: when banks are forced to hold more capital, they naturally become more protective of the money that flows in and out. It's like tightening the faucet. The water is still there, it just doesn't pour as freely. So what does that look like in real life? It means if you apply for a loan, you might hear we're reviewing your file more often. It means transferring large sums could take longer than before. It means banks may hesitate when customers try to pull out significant cash at once. Not because the money isn't yours, not because they're allowed to block you, but because the system is shifting from move fast and grow to move carefully and protect. This is the heart of Basel III Endgame. The goal is stability, safer banks, fewer surprises, fewer taxpayer bailouts. And on paper, that sounds wonderful, but even good intentions create real-world ripple effects. A banking system with stricter rules is like a city adding more stop signs. No one argues against safety, but everyone notices the slowdown. And for retirees, savers, and regular families, that slowdown matters. The comfort of knowing my money is always ready when I need it begins to fade into something softer and less certain. Not dangerous, just slower. That small shift is the first piece of the 2026 story. Because when the rules change, behavior changes. When behavior changes, access changes. And when access changes, ordinary people feel it, long before any headline explains why. So tonight we start with the rule itself, what it is, why it exists, and why America's biggest bankers are uneasy about it. Not to scare you, not to exaggerate the stakes, but to help you see the early signs clearly before the rest of the crowd turns around and asks, when did this begin? This is the first crack in the foundation. And understanding it now will make everything that follows easier to grasp and much easier to prepare for. 2. The systemic stress test. When a system tightens its rules, you feel it long before you understand it. That's the real shift taking place underneath the rule change we just explained. Banks were already carrying pressure from rising interest rates, shrinking loan demand, and weak commercial buildings across the country. Basel III didn't create a crisis, it just added another weight onto a table that was already bending. To see the whole picture, you don't need complicated charts. Start with something simple. When interest rates rise fast, old loans lose value. Imagine buying a long-term savings bond at a low rate. Months later, new bonds pay double. If you ever needed to sell yours early, people would only buy it at a discount. That's exactly where banks are today. They're holding huge portfolios of older, lower-interest assets that look fine on paper, but would sell for much less if push ever came to shove. This doesn't harm a bank as long as everything stays calm. Problems only show up when money begins moving too quickly in or out. And in a high-rate world, people are moving money more aggressively than before, chasing better savings rates, shifting banks' moving investments, or simply withdrawing to cover higher costs. That makes banks extra sensitive. They're watching every dollar because they can't afford sudden surprises. Now add a second layer: commercial real estate. Across the country, downtown office towers are emptier than they've been in decades. Remote work bankruptcies and shrinking companies have lowered demand. When a building loses tenants, its value drops. And when its value drops, the loan tied to that property becomes riskier. Regional banks carry most of those loans. They aren't global giants with thousands of revenue streams. They depend on local malls, office parks, restaurants, and small businesses. When those properties struggle, the bank behind them feels it immediately. Think of a balloon with tiny leaks. One hole doesn't burst it, but several small leaks make it sag slowly, even if the balloon still looks okay from a distance. That's where many mid-sized banks sit today, not collapsing, just slowly losing air. They need stability, not new pressure. Then the new capital rules arrived. Basel III Endgame pushes banks to keep a bigger cushion. Regulators want safety, banks want flexibility. So the system ends up in a tug-of-war: hold more money inside, but also survive higher rates, weaker properties, slower loan payments, and customers moving funds around more than before. This is why some banks have started acting differently. Not dramatically, just carefully. You might notice a loan that once took days now takes weeks. Transferring a larger sum might require extra questions. A business credit line might shrink even when you've done nothing wrong. In each of those moments, the bank isn't telling you there's a problem. It's telling you it wants more time, more certainty, more cushion. Even bank employees feel it. Some of them admit quietly that internal approvals are slower. Managers double-check decisions they once rubber-stamped. They're not panicking, they're protecting themselves. And that protection is starting to shape the experience of everyday customers. The irony is that nothing here looks dramatic. There's no flashing warning light, no breaking news headline, just friction, small pieces of resistance that add up over months. Households are tightening their budgets because everything costs more. Banks are tightening their policies for the same reason everything in the financial world carries more risk than before. If you want a simple image for what's happening, picture a city that suddenly adds 10 new stop signs. Nothing is wrong with the roads. Cars still move. People still drive. But every trip takes a little longer. Every turn requires a little more caution. After a while, you start noticing the slowdown, even if you can't point to a single dramatic change. That's the banking system right now. Stable on the surface, pressured underneath, and moving just a little slower every month as the new rules settle in. This matters because money is not just numbers. It's speed. How fast it moves, how easily it flows, how quickly you can access it when life demands it. When speed changes, people feel it. And over the next year, that slowdown will become clearer, not as panic, but as a shift in how the entire system behaves. The squeeze is already here. Quiet, steady, and easy to miss unless you know what you're looking at. And now that you do, you're ready to understand the next question. What happens when a slow squeeze begins to affect liquidity? The actual movement of money in and out of banks as 2026 gets closer. 3 retirement accounts in the access gap. Most people look at their retirement account the same way they look at a bank balance. There's a number on the screen, and that number feels like money they can reach for whenever life demands it. On good days, that number goes up. On bad days, it goes down. But it always feels like theirs. What almost no one thinks about is the difference between owning that balance and accessing it quickly. Retirement money lives in a different world. It doesn't sit in a simple checking account. It usually sits under a custodian, a big provider, a plan administrator, a broker-dealer. Between you and that balance are systems, rules, and timelines that were designed for calm markets and predictable flows, not for sudden waves of, "I need my money now." You can already see this in how these accounts work today. Many retirement plans have what are called blackout periods. Nothing dramatic, just quiet windows of time where you can't trade or move funds, because the plan is changing, record keepers updating systems or processing big shifts behind the scenes. During those periods, your balance is still yours, but your access is temporarily frozen. No scandal, no headline. Just please wait. Then there is settlement timing. A lot of retirement platforms don't move like cash apps or instant transfers. You request a distribution, they sell assets, they wait for trades to settle, they send the money out. That can take days, sometimes longer, especially if the request lands during heavy market volatility or at the same time as many other people are asking for changes. On paper, you're fully funded. In practice, you're waiting. That's the access gap, the space between the number you see and how fast you can touch it. Basel III doesn't directly rewrite the rules of your 401k or IRA. It doesn't say you can't have your retirement money. These regulations focus on banks and large institutions, not individual accounts. But the institutions that hold and service those accounts are part of the same financial system now being told to carry more capital and take less risk. When those institutions face tighter capital rules, they adjust behavior. A bank or broker under more pressure to look strong on its balance sheet has every incentive to avoid sudden large outflows. It can't change your legal rights, but it can change how quickly requests are processed, how many checks are done, and how many transactions require manual review. That shows up in small ways first. Withdrawals above a certain dollar amount might no longer be fully automated. Transfers from one custodian to another might need extra verification. A rollover that once took a week might start taking 2. During times of stress, some plans may quietly encourage keeping assets in plan instead of moving them out, simply because it's easier on their own liquidity and reporting. Again, none of that means your retirement has been seized. It means the path between your account and your hands now has more gates and more guards. For ordinary savers, the experience can be confusing. They see headlines about new banking rules, hear vague talk about safety, open their app, and think everything looks normal. The balance is there. No warning banners, no flashing lights. Only when they try to move a meaningful amount for a house down payment, a medical expense helping a child, or simply out of caution, do they realize how slow the machinery can be, especially if many people are doing the same thing at the same time. The key point is simple: your retirement money is legally yours, but it does not live in a same-day, no-friction world. It lives inside a slower, more regulated, more layered system. Basel III doesn't reach into your account and change the number. It nudges the institutions behind that account to be more careful to hold onto capital, to review outflows more closely when conditions get rough. That's why understanding the difference between balance and access matters so much heading into 2026. The number on the screen is only half the story. The other half is how many steps stand between you and that number, and how those steps behave when the system is under pressure. The sooner you see that gap clearly, the less surprised you'll be if the path from request to cash in hand becomes longer exactly when you'd prefer it to be shorter. 4. How banks behave under new capital rules. When rules get tighter, systems don't argue, they simply change their behavior. And that's exactly what's happening inside banks right now. No alarms, no dramatic announcements, just a slow shift in how decisions are made, how money moves, and how every request from customers is handled. New capital rules like Basel III Endgame act the same way a doctor's warning does to a patient. Nothing changes overnight, but habits begin to shift immediately. The first place that shift shows up is lending. Banks survive on lending, yet it's the first lever they pull back when they need to look stronger on paper. A banker who once said yes in a week now needs 2. A customer who used to qualify easily now gets asked for more documents. Businesses that renew credit lines each year find the limit trimmed even when their finances haven't changed. Regional banks feel this most. They don't have billions in trading desks or global operations to balance their risks. They depend heavily on local borrowers, and many of those borrowers sit inside commercial buildings that are half empty today. When an office tower loses tenants, the loan behind it becomes heavier. When enough loans feel heavier, the bank behind them becomes more careful. As lending tightens, something else rises in value: deposits. In normal times, banks love money flowing in and out because movement creates business. Under stronger capital rules, they begin to prefer stability instead. A quiet deposit that sits still for months becomes more attractive than a larger deposit that moves in and out quickly. You may have already seen hints of this: a slightly better rate for keeping savings with the bank, more promotions for new accounts, a polite reluctance when moving large sums out. None of this changes your legal rights. It simply reflects a new priority inside the bank. Predictable funding beats fast funding. Behind the scenes, another shift is happening. Committees that most customers never hear about, liquidity teams, risk groups. Internal stress testing units are gaining more influence over daily operations. These teams study every pattern of deposits and withdrawals. They run simulations of what if customers move more money next month. They debate how much cash needs to stay inside the system rather than flow freely. Under the new rules, their voice carries more weight. A transaction that once cleared instantly may now need to pass through their checklist. Not because something is wrong, but because the bank is trying to stay ahead of the new standards before examiners arrive. Customers don't see the committees, they see the result. A gentle increase in friction. That's the real consumer-facing effect of stronger capital rules, not a freeze, not a crisis, just small delays that add up. A wire transfer that once moved in hours takes until the next morning. A withdrawal request triggers a phone call for verification. A loan officer asks for one more form before approval. Even employees notice the shift. Some admit that managers are double-checking decisions they use to approve immediately, not fear caution. But it feels like a restaurant that suddenly decides safety matters more than speed. Orders still go out. Dinner still gets served. But every worker moves a little slower, every step takes a little longer, and the entire place runs with heavier feet. That weight comes from higher interest costs, weaker commercial real estate, more sensitive deposits, and the new capital rules pressing from above. None of these forces are dramatic alone. Together, they encourage banks to move carefully. And when banks move carefully, customers feel the difference even if they can't name the reason. Money doesn't disappear, it just takes its time. A slowdown that begins inside boardrooms makes its way to living rooms. People planning a down payment wonder why their funds need an extra day. Business owners ask why their credit lines look smaller. Retirees notice that transfers take longer than they used to. Not because the system is failing, but because it's bracing. This is the natural behavior of banks under stronger rules. A shift from grow fast to protect first. A system that still works, but with more steps, more checks, and more hesitation. And as 2026 gets closer, that careful posture becomes the baseline. What comes next is predictable once you see the pattern when a system slows itself down. People begin testing it not out of fear, but out of curiosity and caution. 5. The legal framework people forgot. When people start testing a slower system, the natural question follows: if a bank ever struggles, what actually happens to the money inside it? Not the rumors, not the internet myths. The real written into law answer. Most people don't know it because the rules were written quietly after a crisis no one wanted to repeat. The rule is called Dodd-Frank, passed after 2008 to make sure taxpayers would never again be forced to rescue failing banks. It wasn't created for everyday conditions. It wasn't written for normal times. It was built for the rare moment when a large institution tips over and someone has to decide who carries the weight. The word that floats around online is bail-in. It sounds alarming, but the real version is more specific and much less dramatic than the viral version. A bail-in only applies when a bank is already failing and placed into formal resolution by regulators. It only applies to people who count as creditors of that institution, usually large bondholders and uninsured claims. Everyday depositors under insurance limits are not the target. They are protected first because confidence depends on it. The rule exists for a practical reason. Regulators would rather use a failing bank's own internal resources than repeat the taxpayer-funded bailouts of the past. It's the financial version of telling a company, clean up your own mess before you ask the public to do it. Rarely used, rarely needed, but written down in case the worst ever arrives. Understanding this matters because it sits beside Basel III like the second half of a matched pair. Basel III tries to prevent failure early. Dodd-Frank describes what happens if prevention doesn't work. One pushes banks to raise more capital long before trouble. The other removes the option of passing losses outward if trouble still comes. Both rules were designed to avoid a repeat of 2008, not by expanding government support, but by pushing responsibility inward onto banks and their investors. That shift creates a quieter message inside the system. Banks must look strong. Early manage risk earlier, tighten sooner, and brace longer. And that message travels down the chain. A tightening bank is a cautious bank. A cautious bank is slower with lending, slower with transfers, slower with large withdrawals. Customers feel these ripples before they ever see a headline. None of this means people wake up one morning and find their savings vanished. That's not how US banking law works. It does mean the system behaves differently when the goal is to protect itself before protecting growth. Slower approvals, more internal review, a little more attention to every dollar that leaves the building. These behaviors don't come from fear, they come from regulation. A world where the first line of defense is the bank, not the taxpayer, naturally makes banks hold tighter to their own cushions. The forgotten part is that these rules weren't written for individuals. They were written for institutions so large that their trouble could shake an entire economy. But individuals still feel the side effects in small ways. A retiree moves money between accounts and wonders why it takes longer. A business owner renews a credit line and sees the limit adjusted. A household requests a transfer and is told the process needs another verification step. Nothing illegal, nothing secretive, just the machinery doing exactly what the law now encourages it to do. This is why understanding the rules isn't fear. It's literacy. When you know how the system is designed, the friction you feel makes sense. The path from request to result becomes clearer. And the headlines that confuse everyone else stop confusing you. As we move toward 2026, these laws shape the environment more than any rumor ever will. They don't predict crisis, they explain behavior. And once you see the framework, you're ready for the next layer, how ordinary people adjust when the system's guardrails become tighter than they remember. 6. The 2026 window, what actually changes for consumers. As the 2026 rules settle and nothing dramatic appears on the surface, no banners, no alerts, no letters in the mail, the changes show up quietly through the small ways banks begin handling everyday money. The first shift happens inside their reporting rooms. Regulators want clear documentation of how banks manage outflows, so banks start watching those outflows more closely. A transfer that once moved without a second thought now triggers an internal note. A large withdrawal passes through another set of eyes. It isn't restriction, it's scrutiny, the system paying closer attention to movement. Credit is where consumers feel the next adjustment. Higher capital requirements make every loan a little costlier for a bank to carry, so they move cautiously. Mortgages that once sailed through underwriting now come with extra questions. Small businesses renewing credit lines find the limit trimmed or the terms tightened. Homeowners looking for HELOCs see more conservative appraisals. Even people with strong credit notice the tone shift. Banks aren't pulling back from lending entirely, they're just picking borrowers more carefully because every dollar lent out now carries more weight on their books. Withdrawals begin to stretch out as well, especially larger ones. A wire that normally clears by afternoon might settle the next morning. A request for a certified check may involve a second review. Moving money between institutions sometimes requires an extra call to confirm identity. Banks explain these steps as fraud prevention or routine security, and technically they're right. But the deeper reason is simpler under the new rules. Banks benefit from keeping funds inside just a little longer. A slower release feels safer to them. Retirement accounts follow the same pattern. The rules don't change the rights of savers, but they influence the behavior of the custodians behind the scenes. When someone requests a rollover or distribution, the process passes through more checkpoints. Trade settlements take a little longer. Transfers between providers take extra verification. During heavy market swings, delays become more common. Nothing is denied. Nothing is frozen. The machinery just slows under the combined weight of higher capital standards and rising risk across the financial system. By 2026, these small adjustments form a new normal. Not a crisis, a climate. Money still moves, loans still get approved. Retirement transfers still clear. They simply take more time, more steps, more confirmation. It's the kind of change most people don't notice until the moment they really need speed and realize the system they've trusted has shifted to a slower gear. This is the practical side of the new era. More reporting, tighter credit, longer waits for large withdrawals, more reviews for retirement funds. Nothing extreme, just a financial system trying to stay steady by moving carefully. 7. Building financial resilience. A slower banking system doesn't have to put your life on pause. The whole point of understanding these changes is to stay one step ahead of them. When you know how money moves and how it sometimes moves more slowly, you don't fear delays. You prepare for them the same way you'd prepare for a rainy day, calmly, quietly, and with simple habits that keep everything running. The first habit is building multiple rails, not relying on a single account to carry every part of your financial life. Most people keep all their money in one bank because it's convenient. But resilience isn't built on convenience. It's built on options. A basic checking account, a credit union account, and a brokerage cash account create 3 different paths to access funds. If one institution slows down, the others stay open. This isn't diversification for returns. It's diversification for access. You're not trying to beat the market. You're trying to prevent a temporary delay from becoming a personal crisis. The second habit is understanding settlement times. Most people never think about how long transfers actually take until the moment timing suddenly matters. ACHE transfers often need 1 to 3 business days. Wire transfers only move same day if they're requested before the bank's cutoff time. Retirement rollovers can take several days or even weeks. Brokerages have their own settlement periods. None of this is new. What's new is that a slower system makes those time frames more noticeable. When you understand them up front, you stop assuming money moves instantly, and you avoid frustration when something takes a little longer. The more you know about timing, the less you panic when the system asks for patience. The third habit is keeping a small cash buffer, not a doomsday stash, not a bunker, just enough to live normally during short delays. Every household already prepares for minor disruptions. We keep batteries for power outages, spare keys, bottled water, basic medicine. Cash works the same way. It covers the moment when a transfer is still pending, when a debit card gets declined for no good reason, or when a bill is due before money finishes moving. It's not about fear. It's about avoiding inconvenience. A couple of days of breathing room can turn a stressful delay into a non-event. The fourth habit is knowing your FDIC and SIPC coverage. These protections exist to help ordinary people, but they only work if you understand the limits. FDIC insurance protects deposits, checking, savings, CDs up to the legal limit per depositor per bank, per ownership category. SIPC protects brokerage accounts. If the firm fails, though, it doesn't cover market losses. These rules aren't complicated once you see them clearly. And when you do, you can structure your accounts in a way that keeps both safety and access on your side. Literacy is protection. When you put these habits together, resilience stops being an idea and becomes a setup. You have multiple ways to reach your money. You know how long each method takes. You keep a small cushion for life's unexpected timing problems, and you understand exactly how your accounts are protected. Basel III stricter lending, slower withdrawals, none of it becomes frightening when your personal system is flexible enough to handle everyday friction. Financial resilience isn't about beating the banks or outsmarting the system. It's about staying steady when the system starts moving more slowly. It's about being the person who says, "I'm fine, I planned for this," while everyone else scrambles. It's calm, practical readiness for a world where speed isn't guaranteed. And when 2026 arrives, the people who understand these habits won't feel the squeeze the way others do. They'll feel something else instead: control. In the end, none of these changes are about fear, they're about awareness. The financial system is entering a slower, stricter chapter. And that doesn't make it unsafe, it just makes it different from the world we grew up with. The people who do best in moments like this aren't the ones with insider connections or massive portfolios. They're the ones who stay calm, pay attention, and build simple habits that keep life moving, even when the system takes an extra day, an extra form, an extra review. You don't need to predict every rule or every headline. You just need to understand how the environment is shifting and position yourself so those shifts don't catch you off guard. That's real resilience, not reacting, but preparing. And if there's one message to carry forward, it's this: stability doesn't come from the system. It comes from how ready you are when the system slows down.
This video does not promote division within the United States or encourage segregation. All content is presented for the purpose of exploration, analysis, and fostering discussion based on current events, public sentiment, and social trends. We fully respect the United States Constitution and all federal regulations. If today's analysis made you think, drop a comment so we can keep the conversations going. And don't forget to like, subscribe, and hit the bell so you will never miss our next independent deep dive.